Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about income splitting. So what type of income can you split, either past 65 or before 65? Strategies around that. At the end of this video, we're going to walk through a few strategies that we've used with our clients that have saved them, tens, hundreds of thousands of dollars in taxes just through some strategies of income splitting. So we'll go through that at the end of this video. But in this video, we just want to cover off what types of income. We get asked all the time, what type of income can I actually split with my spouse? And is it beneficial, and how do I do it? So we'll go through that in this video. Before we jump into the content, if you're not already subscribed to the channel and you're enjoying what we're putting out here, again, we release videos helping you around tax, estate, retirement, and financial planning for Canadians. Although a lot of our content will help you if you're outside of Canada. But again, we try and help you guys enter into retirement, better foot, knowing what to do, mistakes not to make. So if you enjoy the content, join our community, join the channel, hit subscribe below. It takes 1 second and it costs you nothing. So when we look at tax planning, whether it's building out your financial plan or just tax planning on a daily basis, the end goal, no matter what you're looking at, is to pay less tax and put more money back in your pocket, okay? So there's ways to do that, as you build up towards retirement. We're not going to cover that in this video. But in this video, we want to talk about income splitting, why that's beneficial, okay? So let's just quickly take a look at the math. So if we look at, I'm in BC, so let's take a BC example. Now, if we look at someone earning $80,000 a year, so take husband and wife, couple. Let's say the wife's making $80,000 a year, the husband's making nothing, either retired or not working or whatever it is. So, quite a gap in income. The husband in income tax, federal and provincial income tax, is going to pay around $15,000 on $80,000 of income. Okay, I'm not taking into consideration the pension income tax credit or anything like that. Just pure numbers here. So $80,000 of income, you're going to pay about $15,000 in tax. Now, if that wife was able to split that $80,000, so it's 40 and 40 with her husband, they're both going to pay around $4,500 in tax, or $9,000 total. So that's a $6,000 savings on an $80,000 a year income. So again, splitting income can have a massive difference in the amount of money you have back in your pocket. That's $500 every month in your pocket that you have after tax to spend, right? And in retirement, a lot of you're going to need every dollar that you can get. So if you can look at income splitting, it's going to be absolutely beneficial. Now, I understand that not all of you can income split because you don't have a spouse or common law partner, right? If you don't, that's obviously we've covered other videos on that, how to retire single, some tips and tricks around that. But if you have a partner, a common law partner or a spouse, and you're able to split the income, make sure that you're doing that. So when we talk about splitting income, I will just say, so you're going to wonder, is there a form to fill out, Adam? Is it automatic? So when you split income, pension income splitting, it's not you're giving your spouse or common law partner money. You're just allocating some of your income to them on your tax return, okay? So there's a form you have to fill out. It's a T1032, okay? So you fill out that form, and all you're doing is you're allocating money over to them, okay? A lot of you get caught on, well, I have to pay my spouse or partner, and there's like a flow of cash. It's not at all. It's nothing to do with that. At the end of the day, if we take my example of the wife, drawing out $80,000, let's say she's got a pension of $80,000, and he has no pension, nothing, and that's all their income for the year. She's still taking her full $80,000 of pension. It's just when they go to file their tax return, that pension income, if it was from, let's say, a defined benefit plan, she would be able to split that income no matter what her age is. So she could allocate up to 50% of that income to her husband, so they could make it that $40,000. Again, she's not giving him money or drawing money out of her pension directly to him. It's none of that. It's a form T1032 that they would fill out on their tax return that they and it's basically allocating $40,000 of her income to him. So when CRA looks at it, they say, okay, you both made $40,000. How much taxes? Now, when it comes to income splitting, there's a few things. One big factor with income splitting is obviously you're paying less tax, right? Pay less tax, it's more money back in your pocket. That's a big win, especially entering retirement where we need more money, okay? The second benefit, and this can be a massive benefit for a lot of you, is OAS Clawback, okay? So when you hit that 79,000 range, you start to get your old age security clawed back, okay? But again, so let's take this same example, $80,000. This lady would start to have a bit of an OAS clawback. Okay, if her pension was $100,000, there'd be more clawback. Okay, so her ability to shuffle or allocate half of that income to her husband, brings her net income down, which actually creates no OAS clawback. So again, let's take an extreme example of someone making, 140,000. So let's say they have RRSPs and pension, whatever, and it's really heavy on one side and the other person has zero. We can split that. So to say 140,000 of income, there'd be a full OAS clawback at that point, but they could split half that income with their spouse. Then they're both at $70,000, no OAS clawback. So that's a huge benefit. So not only are you going to reduce taxes by tens of thousands of dollars, but you're also going to get your full OAS clawback now, or OAS, and have no clawback now as well. So again, a double benefit there. So tax savings and potential OAS clawback being reduced. So if we're looking at what types of income can be split, keep it simple. For most of you, your income's coming from either a RRSP or a pension plan, okay? If you have a defined benefit pension plan that's paying out before age 65, you're able to split that with your spouse or common law partner, okay? So pension plan money, a superannuation pension plan, you can split that pre-age 65, okay? If you have an RRSP or a locked-in RRSP, or if you converted to a RRIF already or a locked-in RRIF, all those have to wait till 65 and older to be able to be split, okay? So if you're under 65, draw money out of a RRIF, you cannot split that with your spouse, okay? Only a pension plan. Once you hit 65, you can split your pension plan, you can split your RRIF, your locked-in registered account will go to a locked-in RRIF, that can be split as well. So again, past 65, you can kind of split those other accounts. Before 65, it's really only a defined benefit or superannuation pension plan. There's a few rules in there if you've lost a spouse or common law partner. There's a few other rules, but for 99% of you watching this video, pension plans before 65, RRIFs and LIFs, and pension plans past 65. That's kind of the general rule. That's the easiest way to kind of, without creating a full massive list that will take up 4 screens here. So that's the general rule. Now, if you plan to retire before 65, this is a very important piece. And this is what we roll out with our clients when the cases come up. So before 65, let's say you don't have a pension plan, or you plan to retire before 65. Okay, so let's say you and your spouse plan to retire at 60, and you have no pension, you're just building up RSPs. Now, be aware that if you have one high income earner and they're the one that's putting all the money into an RSP, you're going to want to create a spousal RSP, because if you hit 60 and one spouse has a really big RSP and that's what you're going to start drawing money out of, and the other person has very little, you're unable to split that income, and you're going to run into a bigger tax bill that you could essentially avoid. So how do we get around this? We create a spousal RSP. Okay, spousal RSPs aren't as popular anymore because, again, pension income splitting in retirement. But if you're pre-65 or you plan to retire before 65, make sure to set up a spousal RSP. It's basically a way to income split pulling out, because you can pull money out of the spousal RSP. It's taxing who was the lower income earner, through the earning years. And then the other person can pull money from their RSP, and they both have income going forward, and that could tie you into age 65. So let's say you want to retire at 60. So you have 5 years until you're able to split that income, okay? And you need to pull out $10,000 out of each of your registered accounts a year. You're going to want to build up a spousal RSP of at least $50,000 so that you can pull $10,000 out every year for 5 years to make that income taxable in one spouse's hand and the other in the other. Okay, it's a way to kind of create tax and income splitting pre-65 with RSPs. Okay, so hopefully that'll make sense. Again, retiring before 65, if you don't have a pension plan and you're looking to split income, look to use a spousal RSP. Like I said, there's other income splitting opportunities kind of leading up to retirement. I've covered that in other videos. I'll do more videos in the future as far as, if you have a lower income earner, let's say someone making $10,000, $15,000 in your house, have the high income earner pay the ongoing expenses in the household so that that person can still invest and create wealth. And there's not kind of a loan that has to happen and attribution rules, and it gets a little messy. So there's stuff that you can do leading up to retirement. That's not what we're covering in this video. It's more, okay, how do we plan for retirement, income splitting in retirement? And again, if you plan to retire before 65 without a pension, make sure you set up that spousal RSP, because you can only split if you have a defined benefit or a superannuation pension plan before 65. So one of the best income splitting opportunities that most Canadians look past is the tax-free savings account. So the tax-free savings account was implemented in 2009, and it's one of the best tools to use to be able to split income, because you're able to draw income out and create, an income stream in retirement. but not drive up your taxable income. Okay, so again, let's say you have a husband and wife and they're retired at 60 and you need, $30,000 a year out of your accounts. What you could do is, again, you've built that spousal RRSP maybe to 50,000, so there's 10,000 coming out of there every year. The husband or the wife, the other person, could take 10,000 out of there. So they each have $10,000 of taxable income. Then you could take 10,000 out of a tax-free, either 5 and 5, however the split happens. But you could take money out of the tax-free savings account, keep the income low. Again, these are strategies that you can use to maybe, reduce OAS clawback. If you're in a really low income situation, maybe even trigger GIS. Again, GIS, guaranteed income supplement, is very hard to get. Not a lot of Canadians have it. We don't have any clients on it. We have hundreds of clients. So we don't see it often. But, if you're in a position where you can kind of use a tax-free savings account and kind of time when accounts come out and income comes out of different accounts, there's a potential that you could actually qualify for GIS maybe for a year, 2 or 3, just by able to timing that. So make sure that you build up that tax-free savings account heading to retirement, because it's a great income splitting tool, tax reduction tool, and just creates a ton of flexibility, especially for those large expenses in retirement. So just to summarize here, being able to income split, obviously, it's going to save you a lot in taxes. It potentially avoids OAS clawback and allows you to benefit of, say, a guaranteed income supplement or other government benefits. Again, a lot of provinces, I know in BC here, we have Fair Pharmacare. Fair Pharmacare is help from the provincial government paying medical expenses, but it's based on how much family income that you have. So again, utilizing a tax-free savings to draw some income keeps your taxable income low and maybe gives you more support on that Fair Pharmacare. So there's a lot of peripheral things that can come into your overall income, how it helps you, government benefits, payments, that kind of thing. So again, make sure that you're income splitting to reduce your overall tax bill, but look at other strategies to draw in income on a tax efficient basis as you enter into retirement. So hopefully this video kind of cleared up the income splitting, what you can income split, when you can income split it in retirement. Again, pension plan before 65, pension plan, RIF, LIF, that kind of thing past 65. So again, if you're planning to retire before 65 and you're married, common law partner, it may be worth it to build up both a spousal RRSP and especially a TFSA account. So consider that in your plan leading up to retirement. So hopefully this video helped you out. We'll see you in the next one.